个在 Zoom 的那个同学和老师啊，还有在线的同学老师，今天非常荣幸的请到李涛博士。那么李涛呢是我的好朋友啊，我们几年前就认识。后来李涛老师去波士顿还专门找我吃饭，但是他请我吃饭，他说我都觉得不好意思。那个那么后来在复旦在很多地方也做过报告啊。那么我先简单介绍一下。那么他是一个金融学者啊，金融学家。那么他是毕业于哥伦比亚大学。那么导师是派出 Bolton， 包括那个姜伟老师啊，我记得还有 Andrew Pratt、乃杜这些学者呢都是非常好的学者的人知道。派出 Bolton 是金融学的大师了，对吧？那么他培养了很多特别优秀的学生，我觉得李涛老师就是其中一个。那么然后李老师呢，在Journal of Finance、Journal of Financial Economics 这样的期刊发表过多篇文章，而且还有非常高产。我过一段时间看一次他的主页的话，他的文章又开始增多了，我非常的 productive， 而且做的东西非常的有意思啊。他做的有blockchain 也在做 fintech， 还有今天报告的文章是关于 Municipal finance during the COVID-19 pandemic。那么这个报告呢后边是用英文来讲，因为用英文可能更加习惯一点啊。那么我们再次欢迎那个李涛老师给我们做报告。李涛，你可以开始了啊。
好的，谢谢王老师。现在是可以看到对吧，王老师？这个
Yeah, you can make it full screen. Yeah.
Okay.
Perfect.
Okay. Actually, thank you so much for having me. This is a joint paper with Manuel from Duke and also my student Jing Lu from UF. She has been a very productive person recently. She's only in her third year, but she now has 3 papers. So this is really the first time we're presenting our paper in a seminar setting. So any comments or feedback will be highly appreciated. It's a paper looking at how U.S. municipal bonds fared during the COVID-19 pandemic, especially before March and June this year. I guess as some of you might know that the municipal bond market or the muni market has been quite popular in recent years in the U.S. Investors are looking for yield, given that the overall interest rates are really low for many years. Those munis typically give a higher rate than the treasury bonds, and also they are relatively safe. And plus those things, munis, they are often tax exempt, meaning that if you hold a muni bonds, you do not pay taxes on your profits. So this is one reason why so many individual investors especially in the individual investors are holding municipal bonds. And this is quite relevant for our setting because in the end, we are looking at what is the channel, right? What would be a positive a possible channel that would induce such a quick fall of municipal bond prices and then a quick recovery? Looks like the clientele effect is very strong. There are a lot of retail investors out here who typically are more emotional than institutional investors. This market is pretty large. It's about a $4 trillion market, and it's about 50% of corporate bond market. So it's a very sizable market. And there were lots of issuers in the market. There were over 50,000 local and state issuers. So basically, local governments can issue municipal bonds, and the local entities associated with governments or local entities that are not associated with governments, like a school, a university, they can all issue municipal bonds. And during this COVID outbreak in early March, really a lot of investors got nervous and munis lost their safe haven status and were suddenly considered risky assets. I'm going to show you this graph, which was very shocking to me. You see that in the first 3 weeks of March, the S&P Municipal Bond Index dropped more than 10%, which is very significant given how stable the market is. This market had a bull run for the past 10 years, up to March this year, right? Even in January and February, you see a steady rise in muni prices, but you see a very quick drop in the third week of March, and then the Federal Reserve stepped in and began to guarantee short-term munis in the third week, and by the end of the third week in March, and then later on they had another separate program to buy munis directly from issuers, and this was one of the reasons why munis quickly recovered, and then over the course of the summer it continued to recover, and now a lot of muni issuers seem to be in a better position, but from time to time you see reports saying that next year a lot of the muni issuers might be having issues. If the federal government, yeah.
So you what do you mean by guarantee? So the Fed directly guarantee the provided guarantees to the munis, or some kind of QE?
Yeah, they are. They actually came up with two programs. The first program is a direct guarantee for the so-called money market muni funds. These are very short-term instruments, and that the Fed would actually backstop those instruments. And then a couple weeks later, they came up with a direct program to buy munis from issuers.
Oh, from issuers?
From issuers directly. Yeah.
I see. So it's a permanent market, right? Rather than QE.
Exactly. Exactly. So the first one is really the secondary market function. The second one is primary market. What's interesting is very few issuers use the second facility. Only two issuers, the state of Illinois, as well as the metro system in New York, use the primary market function, but the mere effect of an existing function there really helped the market a lot.
So why so few local municipal bonds are using these second facility? Maybe some kind of stigma.
Yeah, exactly. And we actually saw this happen during the financial crisis as well, right? A lot of banks were very, reluctant to actually use Fed's discount window. Yeah, exactly.
Okay, go ahead.
And one thing I should say is these are not the only programs the Fed came up. The Fed also had other programs to pay out, corporate issuers. But this is out of the scope of our paper, because in our paper, what's important is the local feature of municipal bonds. They are very small. They are typically small issuers in a particular locality, and we can look at the local variations of policies.
Yeah, also tall. So also, it's very institutionally speaking, it's very different from China. So how small can a municipal polity is? So I mean, with a town, or so how small really? I don't know. Yeah, no ideas about US.
Yeah, you're right. So there's a lot of variation. It can be as large as a state. Let's say the state of Florida can issue bonds, but a local school district can also issue bonds.
I see.
A local high school district, and operators of toll roads, operators of airports, operators of local train stations, stuff like that. They can all issue municipal bonds, and even builders who build buildings for the UF actually used municipal bonds to finance their operations. So as long as the operator is sort of associated with the government in some way, they can issue municipal bonds. But the vast majority, sorry, please.
How about a very, very small town? Let's say 100 people can also issue?
Yeah. So towns, counties, cities, they can all issue bonds as long as there's a market for their bonds. Yeah.
So it's very open, very liberal in some sense.
Yeah, exactly. So this is quite interesting, given that there's so much variation in there. I'm going to show you a table looking at the size of the issue. Typically, the issue size is pretty small on average. The issue size is pretty large on average, but at the medium, it's pretty small. So you see a very wide distribution out there.
So another question. So let's say a toll collector issue bonds. So it's also backed by local governments, right? Implicitly or explicitly.
It's implicit guarantee, but I think in general, in the end, those guys would actually, they are able to file, bankruptcy. Because these are more considered as revenue bonds. So in the U.S., there were two types of bonds. One is called the general obligation bonds, and the second type is called revenue bonds. So for the general obligation bonds, these are the general revenue bonds issued by towns, states, cities, and they in general cannot go bankrupt because those entities, they can use their tax receipts to pay the investors. But the second type is more common. These are project specific bonds. So airport, toll roads, train stations, those often can go bankrupt. They're more likely to go bankrupt.
You mean liquidation?
Yes,
right?
yes.
But exactly. some local governments can also file for bankruptcy, right?
Yes, exactly. So, in the U.S. history, in the past 10 years, we actually have seen a few quite big bankruptcy filings by large cities like Detroit. Detroit filed, I think, back in 2012. And then you see Puerto Rico. Puerto Rico is really not a U.S. state, but it's sort of a U.S. entity. They filed a bankruptcy filing a couple of years ago. It was the largest filing ever, billions of dollars on the hook.
Yeah. Okay, that's very good.
Yeah, thank you. So you see that during the summer, it sort of came back, and these days there were a lot of talks about a lot of the issues are healthy, especially schools. In November and December, a lot of school districts issued new bonds because they're really short of money, like universities and high schools. But a lot of analysts are saying next year it will be really difficult for many issuers if the federal government is not allocating money to bail them out. And because actually Professor Wan talked about the difference between China and the U.S. I actually put one little slide over here. While the U.S. municipal issuers were having trouble back in the first quarter, the Chinese government-affiliated vehicles were really issuing a lot of bonds, right? Between January and April. They issued a combined more than 1.5 trillion yuan to finance mostly infrastructure spending to boost economic activity hit by the COVID crisis. And in the U.S., the activities didn't really recover until the fall. But right now, looks like there were a lot of activities as well. But this is also need-based, just like what happened in China. I think one thing that's important to note is this does not appear to be just a liquidity crunch. A lot of people were saying, well, this is just liquidity issues, right? During the crisis, there's no liquidity. No wonder why price dropped like this. But we think this is probably more than just liquidity issues because many experts forecast that those state and government, local governments would be having trouble going forward because, for one thing, they have been seeing declining sales revenue, right? Especially for states and cities. If you look at Florida is really hard hit by COVID. Florida is very big for tourism. And now you see that those parks are shut, right? You know, a lot of tourists are staying at home. So basically, according to my knowledge, a lot of local issuers in Florida are having trouble because they are very dependent on sales tax revenue as well as other narrow sources of revenue. And also at the same time, you see unemployment rate increases a lot in the U.S., right? You know, before the COVID crisis, we had a historically low unemployment rate, but during the crisis, it was more than 10%. Now it's lower than before, but still at a very elevated level comparing to a couple of years ago. And also healthcare costs increased. So a lot of these costs were borne by the state and local governments, but at the same time, they're having less tax revenue. And according to the National League of Cities, nearly 100% of U.S. municipalities anticipate a revenue decline in this year as well as next year. So looks like this is a very severe issue. And the S&P, they gave all the muni sectors negative outlooks. The geo sector, the so-called general obligation sector, airport sector, toll roads, universities, all the sectors are given a negative outlook. So looks like this shock is really large. It's actually much larger than what we saw during the financial crisis. And this, we think, has presented a potential credit risk to bondholders, and especially if the bond is relying on sales taxes and other narrow sources of revenue. So I'm actually going to show you a comparison between revenue bonds and the general obligation bonds. You see quite some difference. Oh, yeah, by the way, defaults have been rising already, and so far we have seen dozens of significant defaults. And this is something I found interesting. There's a local builder in our small town. We have a small university town, and this operator is building housing buildings for the UF. And recently they filed for bankruptcy due to the COVID crisis. But of course, they already had some issues before the crisis, but the crisis really was the last straw for this builder. And if you look at a weekly plot of new issuance between January and May, you see that the second week of March really was seeing this is actually the third week, right? This is the second week. The second week was already declining, but the third week you see really, volume took a hit, and this was the lowest weekly muni issuance in U.S. history. In prior history, you never saw a week had so little issuance of new municipal bonds. And the larger, very large issuers like, very large dealers like Citigroup, they just didn't launch any single bond in that week. But of course, after that, you see the Fed stepped in, began to guarantee some of the bonds, and the market sort of recovered somewhat. But still, you see the average was below what we saw before the crisis. And when the co-authors of our team were looking at this, we got really amazed. Looks like people were not really learning that much, right? Like, actually the first case in the US appeared even before the Wuhan lockdown. The first case appeared on January the 21st. And then very quickly, other states began to report the first cases, but looks like investors were not really taking notice during this time. And we are going to ask why that's the case. But in this presentation, I'm going to first show you a lot of facts, what happened in this market, and then we're going to interpret why those happened, why those things happened. Okay, let me see. So this is an informative plot, we think. So if you look at this blue line, this is the offering yield of new munis that were newly offered. You see that the average daily yield is about 2% before the crisis. And then just starting in March, investors began to be very nervous. And you see that on March the 20th, that was the height of the crisis. for bonds, not only muni bonds, but for corporate bonds as well, the average yield was about 5%. That was an order of magnitude different than the average one, right? But then when the first Fed facility for short-term municipal bonds were in operation, you see it quickly fall down. But still, it was higher than before, and gradually it actually began to go down. But still, you see that the announcement of the second facility around April the 10th also had some effect on the yield. And then the Fed had several new expansions afterwards, because in the beginning this direct facility was very strict. Only certain numbers of large municipalities can use the facility, but then gradually they expand to smaller cities. But still, very few of them have been tapping this facility. Okay, so and then
it seems like the facilities, the effects of facilities were declining, right?
Yes.
So the
yes.
Second and third, no effects, or even some negative.
Exactly. So looks like the first facility was the most significant. A lot of those things were already incorporated in when the first facility came out. It was shockingly high, actually, in terms of the yield, but then gradually it was not that effective anymore. But I think we shall really see. Something might happen next year. Right now, I think a lot of bond investors might be too optimistic. And if you look at places from Los Angeles to New York City, they're really having trouble. Like New York is having billions of dollars in shortfall in terms of their revenue, and New York's costs are actually rising. So that's why you would see such a big deficit, right? $9 billion deficit over the next 2 years. And that's just a little too much for a city like this. And a lot of the government employees are taking furloughs, or they were laid off. So you see that in April and May this year, a lot of them took furloughs, right? More than 1.5 million employees. So this is a really big issue. And we are just trying to understand what really happened and what caused them to happen. So our first question is whether and how specific COVID mitigating policies like emergency declarations or stay-at-home orders. These, by the way, were also issued by local governments in China as well. But they were just called as, I guess their names were called slightly differently. But basically, most of the local governments announced emergency declarations and stay-at-home orders to restrict people's movement during the height of the crisis. And we're asking whether those policies that are aiming at COVID had any side effect for municipal bonds. And we're looking at extensive margin as well as the intensive margin. So at the extensive margin, it's looking at a number of issues. And at the intensive margin, we're looking at the offering yields, right? Here, we're looking at the newly issued bonds. And then we're going to use a differential timing of local policy responses to quantify the effects, because of the staggered manner of local policy responses, we are able to explore this timing, and this timing is quite important. I'm going to talk more about that. And then the second one is, what's the effect of reopening, right? Reopening had been a big issue. There were a lot of arguments among policymakers as well as regular citizens when it was safe to reopen. A lot of states and local governments reopened in April and May, and some of them even reopening in June, and whether reopening would have any effect on bond yields and issuance. And then third, we're looking at the Fed's policy, right? Looks like the Fed's policy had some major effect in helping stabilizing the primary market. By just looking at this graph, looks like it's clear that the Fed played a major role, but still we're going to do a formal analysis and see how much the Fed's policy played a role. And then lastly, which is actually the most important point of our project, is how investors learned in the muni market. Is there any local learning? Is there any other type of learning? And we found that there's a lot of local learning, even in a market as large as the municipal bond market. As I said a couple times already, our setting has a lot of advantages, right? One thing is the issuers are very small. They are local issuers. So it would be easier to explore the variations in the policy response at the local level. Because if you're looking at a large corporation, like what do you call it? If you're looking at, say, GM, right? GM is operating in many different states, many different cities. So at one time, it might be having different shocks. So it's really hard to look at how GM's financial health will be affected by local COVID policies, right? Because they're just all over the place. But if you are looking at a municipal issuer, they are localized, so it's much easier for identification purposes. And also those municipal issuers, because they're small, right? They have very simple capital structure. They usually do not have any equity. But if you look at any corporate issuer, typically they have equity. So that would want to make the picture more complicated. And here it's almost 100% debt financing. Another advantage is there were a lot of issuance. It's much more issuance than corporate bond issues. I was very surprised when I was first looking at this issue. Every day you have hundreds of issues for those small municipal borrowers, but for corporates, it's much less frequent. This is nice because if you look at other papers on the impact of COVID responses on labor issues, let's say, they cannot differentiate between policies, right? It is very difficult, but we can do here. All right. So very quick about data, unless you have any questions about the setting. Although, along the course of my presentation, I would talk more about the setting. Our first piece of data is COVID infections and deaths. So basically, we collect daily counts of COVID infections as well as deaths at the county level. So for any county day pair, we have the number of infections and the deaths. And then we are going to focus on the period before, between the first case that surfaced in Washington State and the end of April, because this is the period investors got really nervous in the market. And we're going to extend it to June the 30th to study the effect of reopening. Many of the cities and states reopened in April, May, and June. And our data source called the Corona Data Scraper. So this is a sort of data aggregator that would pull case and death data from state and local governments directly. As I said, the first case actually was in Washington State. That was very early on, January 21st. And the last case was actually in West Virginia, March the 17th. So this is just the difference between states. You see, there's a difference almost 2 months. I guess one issue is testing, right? If you look at West Virginia, they began to test people very late on. But for other states, they actually did early. So, and then the first death also happened in Washington State. That was more than 1 month after the first case surfaced, and the last death was in April. Was in Wyoming, April the 13th. Now, what's interesting is, looks like a lot of the first cases, the first deaths were happening on the coastal states like California, New York, right, Florida, Washington State. But recently, after the summer, those states in the middle were really having lots of new cases. Like Wyoming, it's a really hot spot right now. It's out of control. So, this is really not a presentation on COVID cases, but as you can see, if you rank the counties by case counts, right, at the end of April, you see that 7 out of the 10 were from New York. It's not surprising given the high population density in New York. But you also see other places like Los Angeles, right? Even Detroit, Wayne, Michigan's over here. So typically these places are having high density. And there were a lot of people, right? Even if you just look at the Queensboro in New York, they have more than 50,000 cases. That's more than China combined, right? Kings County is actually Manhattan. So it's really getting out of control in the US. And this is the top counties by death counts. You see the correlation between the infections and the deaths are very high, right? Manhattan is the highest, followed by other boroughs in New York, but still those places were also having issues. Michigan, New Jersey, right? Stuff like that. So we also collect data on state and local government actions. There's no centralized database. But first, we pull the data from a group of scientists from the University of Washington, and then we manually check their data against their original sources. Sometimes they were making mistakes, but on average, they were doing a good job. And we're going to look at 5 major policy events, emergency declarations. That's sort of the first major information source from the government that conveys some urgency for the citizens. And then, after that, schools began to close, governments began to restrict people together, right? And then the non-essential businesses will be closed. And then lastly, stay-at-home orders were issued. So people cannot really leave their homes. But I guess one important detail, right? Stay-at-home orders in the US are not really mandatory. You can actually leave. It's just advisory stay-at-home orders. Some places were very strict, but at other places like Florida, it's not that strict. You have to stay at home if you don't have, if you're not going to buy groceries and stuff like that. But otherwise, you can leave. Okay, so there were some details over here. Some counties would issue emergency declarations before the state order. Typically, the state would issue emergency declarations, just like in China. But some counties could do that, and then we are going to collect a list of county names and dates for their emergency declarations before the state order. But once the state orders a statewide order, then all the counties will be inheriting the state order. And then the school closures are from Education Week. That's a magazine. Then we are going to study the timing of COVID-19 responses at the county level. We also do some robustness check at the state level as well, but our main study is at the county level. We actually do a number of things to cross-check with other data sources like New York Times. Now, let me just focus on the Fed for some time. As we discussed that on March the 23rd, the Fed was to accept short-term muni purchase from money market mutual funds as collateral for lending to banks. So basically, this is a direct backstop for secondary market short-term municipal bonds, right? These are very, very short-term munis, usually with a maturity less than 1 year. And then on April the 9th, they established a direct purchase facility from issuers. It's called a Municipal Liquidity Facility, or MLF. And then they expanded the scope of the second one a couple of times to include more places. Now, this is sort of a summary of places that issued emergency declarations over time. You see that before March the 2nd, right, in February and January, only very few places. Most of these are coastal places like Washington State, California, right, New York. They issued emergency declarations, but most of the places did their declarations in March, the first 2 weeks of March. And then very few places, I think only one place issued their declaration after March the 15th. And this is a cumulative plot of different events, right? We think the first case announcement at the state level is also very important information events. So we're actually putting it here. And then you see that out of the six different policies, looks like these things are, the gathering restriction and the school closings are relatively close. It's really hard to tell. It's really hard to study those two, but looks like the first case is sort of, relatively away from emergency declarations as well as stay-at-home orders. Now, when you issue a stay-at-home order, automatically that means that non-essential businesses are closing. So they're really the same thing. So we are studying the first case announcement, emergency declarations, as well as stay-at-home orders. We're not going to study these two policy events. So basically, you see that after late March, pretty much, a vast majority of the counties and the states have issued their stay-at-home orders. Now, some of them actually did not issue stay-at-home orders, like the states in the middle. Some of them did not issue orders, but they are really paying the price right now. A lot of them are having a surge of COVID cases and also deaths. Sorry, I have to. And then our Muni data is from Bloomberg. These are our new issues. Our main analysis is on new issues because we're not only looking at offering yield, we're also looking at the number of issues. But we also use the MSRB data, which is the secondary market trading data. It's much bigger than the Bloomberg data to verify whether our primary market results make sense. Looks like they're pretty consistent. And then you see that this is a plot for local government issuance versus state government, right? Local governments issue more in terms of volume on average, but looks like they are more cyclical, right? During the height of the crisis, the local government's issuance volume really take a much bigger hit than the states, although the states' issuance also took a hit, right? And on average, you see this cyclical pattern. And I'm not going to repeat myself with this offering yield and the yield spread picture anymore. The yield spread is offering yield subtract a similar treasury bond yield, right? You see that during the height of the crisis in late March was a really hike of yield, and then once the Fed came in, it quickly fell, right? Quickly fell and then continued to fall, but then afterwards there was not much action going on. So I think this is interesting to show, given that people in the audience don't know too much about the municipal bond setting in the US. Here on the left, 4 columns, we're showing yes.
I want to ask a question. So you are showing yes. The yield curve dynamics. So I'm wondering whether this dynamics has been driven by the changes in treasury itself, because during crisis, there's a flight to safety, so rather driven by the municipal bond itself.
Yeah. So you actually do see some effect of the treasury itself, right? The treasury actually went down a little bit. Yield of treasury went down by actually not too much, but still treasuries went down. So this yield spread curve is steeper than the offering yield curve, but still, even if you just look at the raw offering yield, that's very significant, right?
I see.
So so actually, exactly. And this is very interesting, given that afterwards you see that they're almost parallel. So there was not much change in treasury relative to munis afterwards. So they were kind of in parallel, but before there was some difference.
I see.
Yeah. I think the treasuries, before the crisis, it was close to 2%. During the height of the crisis, it was like 0.6.7%. So there was some change there. So in our analysis, we're going to look at both. We're going to look at raw offering yield as well as yield spread. And do we have similar results? Looks like we have pretty similar results.
Okay, cool.
Yeah, thank you. So this, let me spend some time on this. You can see a lot of information from here. So let's look at those, the first 4 columns. These are bonds issued by local governments and entities associated with the governments. You see the average offering yield is very low, right? Comparing to yield in China, it's only 1.8%, but the coupon rate is actually pretty decent. It's 3.2%. Given we have such a low inflation environment, it's very attractive for some investors. Now, why the offering yield is much lower than the coupon rate? I think it's because a lot of the bonds are selling at a premium. So basically, the price is much higher than the face value. So if you look at maturities, it's about 10 years on average. Most of these bonds issued by local governments are general obligation bonds. So they are backed by tax revenue of the local government, 70% of them. Most of them are investment grade, right? Almost 90% of them are investment grade. But this doesn't mean that they are very safe instruments. During the height of the crisis, you see how quickly their prices drop. And most of them are federal exempt, meaning that if you get a profit on the bonds, you don't pay any federal taxes. And also most of them are state exempt. You don't pay state taxes as well. And that's one reason why they are so attractive especially for high wealth individuals. And actually, in one issue, you can issue different bonds. Just like a corporation, you can issue bonds of varying maturities and coupon rates as well. So you see there were really a lot of issuance out here. And if you look at bonds issued by states, they're much larger, right? Their face value is on average about $14 million, comparing to $3 million for bonds issued by local governments. And their offering yields are a little higher. Coupon rates are also a little higher, also have a longer maturity. Now, what's interesting is most of these are not general obligation bonds, meaning that the state is not standing behind those bonds. Okay, so basically, most of these are revenue bonds, project specific. The state can choose not to bail out the project, so these are more risky, and that's one reason why the offering yield is higher. But still, most of them are federal exempt and state exempt. Another big difference is more than 20% of the bonds issued by local governments are insured, but only 3% of the bonds issued by states are insured by insurance companies. So again, these are more risky. But more of the state bonds have investment grade by 95%.
So just ask a quick question.
Yes.
So are these bonds has CDS on the markets?
Yeah, this is a really interesting question, Yongqing. No, actually, the vast majority of them don't have CDS written on them. Only the very large ones. Only the very large state bonds and only the very large local bonds are having CDS written on them. I actually have another ongoing project with other co-authors looking at the CDS on the bonds. We found only about 10% of bonds have CDS outstanding.
I see.
Yeah, so I guess you were thinking, CDS is more like an insurance policy, right? Yeah, it is sort of similar to insurance, but no.
I see. So are you using, for those who has CDS prices? Are you using the CDS price?
We are not. Yeah, sorry, please.
Oh. I mean, are you using the CDS prices in your research in this paper? No.
Oh, in this paper, we haven't done it because we feel like it is just one of the control variables, and we also have a specification controlling for bond fixed effects. So then we don't have to control for CDS. But in my other project, we actually look at how CDS would affect muni default, and actually CDS plays a major role. It's really important.
You mean it makes it more likely to default, or less? Makes it less likely to default. Actually, we were thinking, So we were originally thinking of perverse incentives. Potentially, you were also thinking about that, right? If you have CDS outstanding, the investors might be pushing for a quick bankruptcy filing, but we find the opposite. And we think the reason is of another adverse selection. Only the very large, the strong municipalities can issue CDS. Especially very large ones. The smaller ones, even if they want to issue, there's no market for them. They're too small. You see that the average par value is only $3 million. At that size, no CDS issuer will be happy to write a policy on them. But there were very large ones like Detroit, Puerto Rico. They all have CDS policies, and the CDS policies were very actively traded. Especially before they filed Chapter 9. So beyond these selection effects, are there other mechanism that makes it less likely to default? So you are talking about the selection channel, right? It's sort of like an advantageous selection rather than a reverse selection.
Yes, exactly.
Right. So good selection. Except for the selection, are there real effects, of less and more monitoring or something, right?
So I think this is quite interesting. We haven't really looked at that, but this is something we can look at. What I know is there's another paper looking at conflicts of interest in the market. How the banks were conflicted. I mean, there were a lot of local banks that are doing issuance for the local issuers, and there's one paper looking at conflicts of interest there. But I think it'd be useful to look at any other selections there that would be good or bad, right? Yeah, so I have to think about that. But I think this will be a very interesting direction given how important the market is.
Yeah, so that's huge. So there's also research on corporate defaults or something.
Yeah,
yeah. Municipal.
Exactly.
Yeah, go ahead.
Yeah, so this is some breakdown of different sectors. You see that this column, right? These two columns are on bonds issued by local governments, and this is issued by state governments. So let's focus on those two columns first. First, we'll look at amount issued. Education sector, high schools, elementary schools, and the universities, they are the biggest issuer of municipal bonds before, right? Before and also after the COVID crisis. And if you look at geo bonds, these are second, and then other sectors, these are usually the so-called revenue bonds, like transportation. These are project-based issues. They are much smaller, and then you have health, right? Healthcare, utilities, etc. And if you look at bonds issued by states, the geo bonds are the largest sector, followed by education. There were state universities like UF, right? If we issue a bond, in general, that's considered as a state issue. Healthcare is also pretty big for states. First, we're going to just look at some simple correlation. We are not going to claim causality here, but we're just looking at whether bond yields at the local level are correlated with the COVID severity at the local level. So I stands for the municipality, I stands for the bond, C stands for the county, right? We're looking at the county picture, and the T is the week. So we are looking at a weekly picture here. And this COVID severity is proxied by the number of cases, the number of deaths, or the growth rate of cases, or the deaths in past 2 weeks. We can also do a thing like that, the number of cases per 100,000 population, which is widely cited in the media. Now, other than the bond attributes controlled by XI, we also control for county fixed effects and the weak fixed effect, right? So these are important to control. These are the county fixed effects are time invariant. But we also control for time variant county level specific trends, which is the county fixed effect times the week, right? This is really capturing the county specific time trends, which could be correlated with the timing of COVID cases and deaths at a local level. And an alternative thing is to do the state times day fixed effects, which we found is giving us similar results. We're going to use the same framework to study weekly new issuance. So this is just for yield. Now for the event study, right, we're going to look at those three types of major events. The first case is emergency declarations and stay-at-home orders or lockdowns. We're going to just regress the yield on a dummy, whether on a given whether in a given week, this is the event week or not, right? So if it is a event week, it's 1. If it's not event week, it's 0. And for the Fed policy, we are going to use the same specification, just replacing policy with those two facilities. Okay. There's a potential issue with the setting here. This is really the classic event study setting, right? But if you look at some new published papers, they claim that because the local government policy shocks are not static, right? Typically, when you use a event study framework, the post here or the policy here doesn't have a C here, right? So this means this policy is time variant at the local level, right? Each locality has a different policy time. But usually, policy shocks are across the board, right? That's the classic model. And now there were new papers saying we cannot use the same framework to study this issue. We need to use more sophisticated methods. We have tried those alternative methods. They give similar estimates, especially because we're looking at a relatively short window. It's just 4 weeks before and 4 weeks after. If you look at a long window, that'd be more problematic because those papers found that some of the estimates will be biased if you look at the long-term effects. All right, so let me first show you some correlation studies here. You see that, let's focus on column 1 to 4, right? That's using the number of cases, number of deaths at the local level, and see whether they affect the offering yield. It looks like offering yields are positively correlated with the number of cases, and also positively correlated with the number of deaths. And in terms of the magnitude, the county level cases double. When the county level cases double, the offering yield would increase by 5 basis points. It looks like small, right? 5 basis point is pretty small in general, but if you look at the unconditional yield, it's only 1.7%. That means the marginal increase is 3%. Okay, and the marginal increase for the number of deaths is actually higher. It's about 4.5%. So that's pretty significant. And if you look at, this also suggests that investors seem to pay more attention to deaths instead of cases. Why is that the case? Because for cases, it's affected a lot by testing. Some locations have less testing capacity than other locations, but for deaths, usually the count is more uniform, but still there are some differences. If you look at the yield spread, we have very similar results. Okay, most of the control variables do make sense here. You see that if you control for credit rating, right, when a bond has high rating, its offering yield is lower, right? It's less costly to offer. And if a bond has a longer maturity, the offering yield is higher because there's more duration risk. If a bond has a tax exempt status, then the offering yield is lower, right? These are more attractive for investors. You don't have to offer a high yield as other bonds that don't have tax exempt status, right? So, but here the message really is the number of cases, number of deaths seem to matter for the offering yield on average, and also the bi-weekly growth rate in deaths matters for the offering yield. So it looks like investors care about deaths more than cases, which are less affected by testing capacity. And if you look at new issuance, that's a pretty similar picture, right? When cases increase, you see the number of issues decrease at the local level. And it's similar for deaths as well. Okay, now I'm not going to spend too much time here because it's really just a correlation study. It doesn't give us any causal interpretation because our main task is looking at how those different policies have a shock, right? So here you see that we are presenting an event study on 3 major types of events. The first, case announcement, emergency declarations, as well as stay-at-home orders. You see there's really nothing going on here for first cases. Looks like investors were not paying attention to first cases, at least in earlier periods, right? In later periods, a lot of the states and the local governments have already issued the emergency declarations. And if you look at emergency declaration, looks like that's a lot of bite, right? So let's just focus on column 4. We control for bond attributes as well, right? You see that in the week of the declaration, the offering yields increased by 70 basis points. 70 basis point is really a lot. That's 0.7%, right? Considering the average yield is only 1.7, that's very significant, and it continues to increase. And if you look at stay-at-home orders, there's some effect in the first week, but then there's really not much going on afterwards. So it looks like maybe the stay-at-home orders were imposed too late. So when the governments imposed lockdown orders, investors already responded, right? Because emergency declarations were issued beforehand. So this is the difference. You see that as soon as emergency declarations were issued, you see a big jump in bond yield. The difference is 70 basis points difference relative to negative 1 week, right? And then continued to increase, then it decreased. Why? Because at that time, the Fed began to guarantee some of the short-term bonds. But for stay-at-home orders, you already have a jump beforehand. It looks like, those orders itself are not that useful. Okay. And then if you look at the number of issues, that's a similar story, right? There's a lot of effect for emergency declarations, less effective for the first case announcements. If you look at a dummy for whether you have issuance this week or not, or the number of issues, you have similar results. I think this is quite interesting. This is a sector breakdown of muni issues in the 4 weeks before an emergency declaration versus 4 weeks afterwards. And we show the number of bonds, the total amount issued, and the percent of a total amount, right? You see that these sectors, we call them resilient sectors. These are water, sewage sectors, utilities, and housing. These are really essential sectors. And you see that if you compare the 4 weeks before a declaration versus 4 weeks after, right, the change is not that great, right? So the total amount issued for water sewage was about $1240 million, and beforehand, and after that, it actually increased. So the percentage of total amount issued increased for water and sewage. For utilities also increased. Now the question is why? It's because these are essential service businesses, right? Whether the economy is good or not, people still use those services, and also they're allowed to hike rates when they have a decline. They have a decline in water or sewer usage or utility usage. So I think that's one reason why you see an increase here. Now, if you look at the less resilient sectors in the middle, right? These are the education, the geo sector. There were quite some fall, right? For education, a fall of 2/3 almost, right? Geo also a large fall. But what's really significant is the very hard hit sectors like the transportation sector, airports, toll roads, right? All those sectors, because the economy was shut down, there was very little travel going on. You see that before they were really one of the largest sectors, and afterwards they were very small, right? And also the dedicated tax revenue sector, they were reasonably large beforehand, but now they were much smaller. Okay, so I thought this is interesting, a picture to see. And we also look at the physical strength of states based on Moody's stress test. So basically, they're looking at the physical shock with a moderate recession scenario. So there were 10 states over here: Pennsylvania, Illinois, Florida, those states, New Hampshire, and New Jersey. When they have a modest recession, they are going to have a revenue shortfall more than 5% of the total revenue. So they are the most affected states. And these states are in the middle. These are less affected. And then those states, most of the states are having surplus. So lots of states heading into the COVID crisis were pretty healthy, but there were unhealthy ones. So here we look at an average picture, right? Using a different approach, looking at whether the offering yield suffers more in more resilient sectors, or whether they suffer more in physically less healthy places. You see that in more resilient sectors, the offering yield actually goes up less than sectors that are less resilient, right? And this difference is about 40 basis points. And if you look at physically unhealthy places versus physically healthy places, the difference is about 20 basis points, right? So it looks like there were some differences. And this kind of results suggest that investors do monitor credit quality. It's not just a liquidity crisis, but in general, it's very hard to differentiate between a credit crisis and a liquidity crisis during a COVID crisis like this, because everything happened really fast. I'm going to skip all these. Now, this is the Fed picture, right? As soon as the Fed began to backstop the short-term municipal facility, you see the yield dropped a lot, right? Dropped. Yeah.
So have you sort of decomposed the spread into liquidity spread and default spread?
Yeah, this is a great question, Yongqing. We actually did it. We followed a paper by Schwartz. That's Bill Schwartz's son, right?
Yeah, standard approach. Yeah.
Exactly. So we actually followed his method, and we see that most of the component is on the credit spread, not on liquidity.
Okay.
Yeah,
right.
So that's kind of consistent with his method. Now, I spoke to him, and he agrees with our message, but his point is, because everything happened so quickly, it's really hard to give because our estimation window is very, very short, unlike his window, which is very long, right? So,
I see. Yeah,
in a very short window, it's hard to pin down. But at least our suggestive evidence says the credit component mattered more. During the crisis.
Makes sense. Yeah, because it's fundamental risk.
Exactly.
Okay. Great.
Yeah, thank you. Okay, so that's the Fed, and then now we also look at longer bonds versus shorter bonds. Again, to our surprise, the longer bonds, the Fed's policy were much more affected on longer bonds, not on the short-term bonds. Although the operation was to backstop the short-term bonds, it looks like the short-term market was much more affected than the longer-term market. This is what we found in the data. There was barely no change across time for the short-term bonds.
So what's your interpretation?
So there were actually reports saying a lot of the short-term bonds are having a maturity between 6 months and 1 year, and this could indicate that investors feel like the economy would suffer in the near term, but not in the very long term. The COVID would actually pass in 1 year or two when the vaccine comes out, but in the near term, they would really be affected. And we think that that's probably one plausible explanation.
I think you can pin down. You sort of not pin down. You can test this channel using the news on on the new vaccine.
Yes.
Yeah.
Right.
So recently, there's several kinds of to see whether this is the case.
Exactly.
Keep other things constant. Yeah. That's okay.
Yes. Thank you very much, Yongqing. All right. So that's very helpful. Let me see. I have about 20 minutes, so let me just skip this. These are consistent. The reopening is very important, right? Reopening happened began to happen around mid-April, and then throughout May and June, places began to open. You see that in early May, a lot of places began to open, right? Places were just very eager to open. And you see that there's a clear trend, right? There was really not much going on before reopening. As soon as they open, you see that yield began to drop. Looks like investors do respond to reopening very strongly. Now, after showing all those primary market-based weekly study, let me just give you a quick snapshot of the daily message from the secondary market. This is a much bigger market. There's less selection going on because these are already bonds that were issued. These are outstanding, right? Bonds that are traded. There were millions of such bonds out there. And you see that when the emergency declaration hits, right, it also goes up very quickly. Although there's some short-term, expectation beforehand. But for reopening, you see that nothing going on beforehand seems to be going down right away. Okay. Now this paper originally was very descriptive, just showing you the facts, how they responded to lockdowns, to reopening, stuff like that. Yes.
So just want to confirm with you. So previously, mostly using the primary market data, right?
Yes.
Previously. So
yes.
I think for your purpose, I think maybe the secondary markets give you better identification, right? Because you can use using the panel structure of the secondary market data.
Yeah, that is true. But even for the primary market, we are also using panel. The only issue with the primary market is there were fewer issuance. So basically, it's hard to do a daily study. We have to cluster for weeks and do a panel data at a weekly frequency. But as you said, the secondary market would be better to do that. So now we're really changing those. We are beginning to change the primary market study with the secondary market picture.
Right. Right.
But because one thing you can, sorry.
Go ahead.
Sorry. No. After you.
Go ahead. Just finish. Yeah, you can finish up. Yeah. Go ahead.
So one thing we cannot use the secondary market data to study is actually new issuance, right? Those things we cannot study.
Right.
But otherwise, I completely agree with you that we should use the secondary market data to study reopening and the lockdowns.
Yeah, I mean, you can take the secondary market as the intensive margin, and primary market is the extensive margin, right?
Exactly.
So also, in terms of the bonds, I think for the issue, the primary markets, even though you can use the panel structure in terms of the municipality, right? But in terms of the bonds per se, so each issuance is different.
Right, you're right. Exactly.
Not so much, right? So not so much
exactly
in terms of the bonds level.
Exactly.
So
exactly. At the bond level, we cannot control for bond fixed effects versus in the secondary market, we are going to do that. And I'm going to show you. Right. I'm going to show you when we look at social learning.
Okay.
Yeah. So we think showing the facts are interesting, but what is the channel behind this, right? Why investors are responding so slowly? I mean, there's, as you see, why investors not expecting, right? Why investors really slowly react to those events? Maybe there's some social learning channel over here. So we follow a paper by Johannes Strober from NYU. We create a so-called social connected index. So it's using Facebook data at the county level. So basically, for county I and J, we first counted the total number of Facebook friendship links between those two counties, and then we actually divide this number by the Facebook users in county I and the Facebook users in county J. Sorry, this is a typo. Yes, this should be J.
It's great. Yeah, it's great because I have thought about sort of giving you the advice of using this connectiveness data, but you are already using this. Cool. Yeah.
Thank you. So because why people not learning, right? These are local bonds, so typically the investors, and actually a lot of the investors are just local people. These are wealthy local guys. Why they're not learning? So maybe looking at whether they learn socially would be a interesting place to look at. So basically, this measure says if the measure is twice as large, it means a given Facebook user in county I is twice as likely to be friends with a given Facebook user in county J, right? So, and then we come up with this measure called social proximity to cases. We can do the same for lockdowns, for emergency declarations. We can do that, but for cases, we're going to give a dummy, right? So, for a given county I, right? So, county J. Let's actually use J because we're going to sum across J's. So for county J, if the first case surfaced today, then any days before today would be 0, and any days after today would be 1. And then for another county, we do the same. And then we're going to evaluate these dummies using their social connectedness we just created here. So for two counties, if county I and J are very much connected, then county J would have a higher weight in this social proximity measure. So more connected counties would have a higher weight. And this measure itself is between 0 and 1, right? Because, all those things are between 0 and 1. We can do a similar measure for US states as well, for bonds issued by states. And also we can use the number of cases. Now, the problem with using the number of cases is, there was a lot of variation in terms of case reporting. Some places are reporting quickly, some places, reporting slowly. So we feel like using a dummy is better, but we can try using number of cases as well. Now, this is sort of the first peek at the relationship. We're looking at investor attention using Google search index for coronavirus during that time. Google has a tag for coronavirus. That's the virus itself. And we are regressing the Google search index, a scaled one for each county. For each state, because the Google search index is at the state level. We cannot find any county level index. It'd be really cool to have a county level one, but even the state level one works. So we regress the Google search index for coronavirus on the dummy, whether on a given day the state had a first case or not, it's 0 or 1, and then on a lagged connectedness measure we just created here, right? Let's just look at the 4 samples from January to June. The first case, the first case does matter, but the lagged, the social learning channel actually matters more. This magnitude is 4.6, right? Increase in the Google search index, but this one, the mean is 0.5, and the standard deviation is also close to 0.5. So if you have a 1 standard deviation increase in this social connectedness, then the Google search index would increase by almost 6. So this effect is actually stronger than the state's own first case. These are first case from socially connected states, right? And if you just vary the time window from March to say April, we have similar results. Now, for the interest of time, let me go to the bond yield regression, which is more important for us. Now we're looking at the state level. We are looking at the county level, and we can control for bond fixed facts, right? Our first, so let's just look at, let's first look at this column. This column is the key column. We control for bond fixed facts, and we control for time trend, as well as there's something that's messed up. These should disappear. But anyways, if you look at those two coefficients, that's really telling a lot, right? a state's own first case does not matter as much. It only matters 0.1 basis point. 0.1%. But if you look at social connectedness, right, a 1 standard deviation increase in social connection to other counties, your own bond yield would go up more than 2%. That's a lot. I mean, 2 percentage points, that's really a lot. So, I know that it's really hard to increase the social connectedness by 1 standard deviation, but that's a commonly used one. Even if it's just by half of 1 standard deviation, still that's very significant. It's much more important than the own state's first case. So it looks like people are learning from their friends. People are not really learning from official announcements how important the first case is. So we found this is really, really interesting. We're very excited in finding this.
I'd rather ask you a question on on these muni bond markets. So who are the minor buyers? Is it retail investors?
Yeah, so we're typically local retail investors.
So I see. So you mean these learning channels really matters for these people?
Yeah, and a lot of them, like my colleague Jay Reader, he actually buys municipal bonds himself. So he does direct purchase. But some of them also buy through funds. There were a number of mutual funds that are buying local municipal bonds. Like, typically these municipal bonds are classified by state. You have BlackRock, New York State municipal bonds. So
can you control for these institutional ownership?
We can, yes, we can control for institutional ownership as well. Yes,
I see.
So that is very important here. But what's interesting is even those mutual funds, almost all the investors are local retail investors. The pension funds don't invest in this market because the pension funds cannot save money by investing in this market. But taxpayers save money. So that's why we think there's a direct link between learning at the local level and bond yields.
I see.
Yeah, thank you.
So also, it's not very clear. So you are learning. Let's say. So the market, I guess, is local. You mean, right? In some sense.
Yeah. So what I mean by local learning is I learn from my friends in other localities.
Yeah.
I don't learn from official news so much.
I see.
Yeah. So maybe I should better call it social learning, not local learning. Local learning is sort of confusing. It's I learn from people I know, not I learn from official governments. And also in the U.S., maybe you have noticed people do not really trust the government so much, especially this year. So people are not. People are mistrusting the government a lot. Especially those who support Trump, they don't trust the market. So I guess all of these reasons sort of gave rise to social learning through your friends and the family members and etc. So if
can you also distinguish between trust in local governments versus trust in federal government?
How should we do that?
I think it's different. People do not trust the federal government in the US more.
Yeah.
Because the local officials are they elected by themselves.
Yeah, I see.
More tailored to their preference.
Yeah, I see. Trust local.
That's the key. That's the key for federalism, right?
Exactly. Yeah. Okay. Actually, that's cool. Thank you. And then, if you look at the stay-at-home orders, that's very similar picture. Now we are restricting our sample before March the 23rd when the Fed began their operations. So when the Fed began have their operations, things have changed a little bit. So we're really looking at, in the absence of government intervention, what happened. Again, you see pretty strong learning, but this learning now is much less than the own place.
Push your logic a little bit further. I think also interesting maybe to look at the liquidity, right? So if there's more social learning, so people's consensus may have more consensus over the bonds, some bonds, right? Then the liquidity may decrease somehow, sometimes.
Yes. Liquidity effect.
Opinion, right? If the different opinions, I don't know. Maybe in the stock market is the case. Yeah. In the bond market, sometimes maybe the opposite. I don't know. Maybe you need to test.
You're right. Sure. Thank you. This is very useful.
Or it seems like very natural to link the learning with the consensus disagreement models.
I see.
Yeah. So less disagreement, maybe more liquidity, right? So this holds in the stock markets.
Yeah, I see. Okay.
Go ahead.
All right, that's cool. Thank you. And then, if you look at the reopening, again, has, the lagged social connection is really affecting the bond yield around reopening a lot. So if you see your friend's county has recently reopened, you actually react strongly, right? Versus you react to your own county's reopening. So so that's that. And then let me just quickly conclude, given I'm running out of time. We first look at a correlation, just show a very simple correlation of bond yield and yield spread and how they increase relative to increases in local COVID cases and death counts. And then we look at different policies, including emergency declarations and lockdowns, how they would affect bond yields. We in total, as well as in different sectors, right? We found that transportation sectors and the dedicated tax bonds were really hard hit, versus other sectors, physically unhealthy places were really hit, but not the physically healthy sectors. And it looks like the Fed's interventions really mattered a lot in the market. And also after the Fed's intervention, reopening by local governments also had a huge impact in lowering bond yields. And lastly, we look at a possible channel of social learning and how social learning would affect bond yields. It looks like a lot of people tend to learn from their friends. If your friend's county just got locked down, your friend's county had a first case, your friend's county had a reopening, you actually react more likely than your own state, your own county's issues. Okay, so that's that. Thank you very much, and Happy New Year to everyone.
Yeah, so the call is great. So, firstly, it's very topical. It's on the COVID-19, but also it's not so many people studying municipal bonds, but also you are combining these two very topical questions, and also I like also your mechanism of social learning. It's a very novel channel, I think, in the literature, not just in the COVID, but also in the finance literature. I think. Social learning in municipal bond market itself, I think, is very novel contribution of your paper. It's really
so
cool, because also the sustainable data just came out a couple of years ago. So it's you can leverage the data.
Yeah, exactly.
So I like this perspective too. Okay, so generally I like a lot of people lost. So I have give some comments, discussion during the presentation. So any question from the audience? Mostly they are students in Fudan. some professor at Zhejiang University also, Xiao right?
Hello, good morning or good evening, Professor.
Hi.
Yeah, go ahead.
Thank you for your paper, and I have two main questions. Well,
sure.
May I ask in Chinese? I'm afraid
yes,
I'm
sure.
Yeah. Now we can be talking. We can speak in Chinese. We can speak Chinese.
Yes.
说老师好，就是
没问题，大家可以说中文，可以的。
我两个小问题啊，就是第一个问题就是这个哲学上的，就是我看您用到了 SCI 这个指数，就是您选择这个指数的这个过程是怎样的？就是您为什么会想到这一点？之前有没有用到其他的一些类似的替代指数，或者说其他的不同意义上的指数？还有第二点就是您这个SCI 这个指数只是就是说明了他们有关系，还是说就是证明了它的确存在着一个单向的渠道，比如说什么东西会影响 SCI， 接着 SCI 再影响这个 yield 这样一种流动的渠道，像就这样两个问题。
I see. 我们是怎么想到 SCI 的呢？我们就是一直在想说，为什么投资者没有很快的 respond， 尤其是 first case， 我们就非常 surprised， 就是为什么过那么多天投资者都没有很快的 respond， 然后我们想，因为就是 first case 也好 lockdown 也好，这些就是 government 的 news 很快就是出来了嘛，对吧？然后就看上去投资者并没有follow 这些 news， 并没有 learn from the news， 那还有其他什么的 channel， 我们就像 alternative channel 可能就是一个 social learning 的一个 channel， 然后我们试了一下，发觉是有结果的。然后呢，你的第二个问题是，说是不是这个 social connection 本身会受到一些其他的 variable 影响，是吧？
对，就是类似于因果性的这种。
对，这个 social connections 我们是用的crisis 之前的这个 social connection。对，这个是用的2019年底的 social connection。对，所以它本身不会受到这个 COVID crisis 的影响。
所以说就是能证明比如说什么东西先影响到了 SCI， 从而 SCI 再影响到yield， 还是说反过来？
我们就是觉得是这个 是就像你说的，什么东西先影响了 SCI， 再影响了 yield， 就是说这个我们其实也不能证明，对吧？我们因为看不到这 Facebook users 的聊天，但是我们这个 large sample somehow 能够给我们一个 consistent 的一个 picture， 就是说大家是通过这个 social 的渠道来获得信息的。不一定100个人，这100个人都是用这个信息，不一定这100个人都获得了信息，从这个 social connection 的渠道，也不是获得信息的所有人都一定是就是卖了或者买了这些 bonds， 但是就是说我们感觉其中相当大的一部分投资者是通过这个渠道来获取信息的，然后他们也是用的这个信息，不然我们很难看到，就是说这个 investor attention 也好，这个 bond yield 都有response。
好的，我知道了，谢谢老师。
没有，谢谢你。
对，其他的同学或者老师还有问题吗？
那个，我想问一下啊，李涛，老师好，
小倩你好，
就是这个，
知道小倩教授，来，小倩来说，张老师啊，
这个
你给我静音，你静音没有静音？
没，我讲话听见吗？就是这里面没有它的各个 county 的财政情况吗？
对，这个问题很有意思，张老师，就是我们其实有想拿 county 的财政情况，但是这个数据非常非常滞后。现在最新的 county 的财政情况是2017年，不是2016年的，就最新的就没有。
而且 关键的问题是你要用周啊或者日就会出现这个问题。那财政情况它最多就是一般我们用都是年度，对吧？
季度的吧？
对，
可能也没有办法配上去。
对，所以就是说我们在这个 test 里做了一个折中的办法，就是我们看了一下这个 forward looking 的一个 mooded test， 这个还是一个周的 picture， 就比较 coarse， 没有那么详细，但好像这个 census 可能明年吧会 release 2019年的 county 的财政信息。
这个我觉得中国的这个数据还是挺好的，我原来不是太懂的，然后最近我查了很多这种数据，发现这个中国的这个财政数据啊，虽然我们国内搞财政的人很少，但是这个数据相当的好，就是什么
是吧？是吧？那很有意思。
而且特别还挺新的，比美国的要新很多。就是到什么这个医院的床位数啊，什么这个每个人呢花的医疗的费用啊都有，这个太厉害了。
对啊，那很有意思啊，我觉得，就是中国有没有人研究，就是说地方债和这种财政的问题的 paper， 应该肯定有吧，张老师？现
在这个是一个蛮火的问题，但是他们做财政的人比较多。然后其实我觉得我们从金融的角度做这个问题会更好，因为实际上如果是城投债，它就是个 corporate bond。这个里面的那些财务指标啊什么的，只有我们知道，他们其实没怎么使用，他们都是从财政的这种角度去考虑，就是公司的这些特征啊，就是都没有。然后我就是上一周我去讲一个文章的时候，就我突然弄了很多啊，就是公司层面的许多数据，把很多就是我们从金融的角度看到的东西给出来了，比如说有毒资产啊、虚化资产啊、什么债务风险啊什么这些。然后我觉得这个也挺好，就是跟他们有很大的不同。有机会我们详细再聊一下，我觉得还
好的。好的，谢谢你，张老师。
对，其他老师还有同学有问题吗？其他可能都是同学为主，包括我还有一个学生在美国留学的叫吴贤，有问题吗？李卫还有等等，董文没有问题。那李老师，那要不就今天就到这儿吧，好吧？
好的。
你那边
谢谢大家。谢谢王老师。
不客气。你在美国是跟现在？
我们现在差13个小时，我现在大概9点半的样子。
有点还好，对，那还不是太晚啊。
不晚。
反正我们期待那个李老师下次到复旦当面，就是见面能够可以请你吃饭什么的，对吧？可以。
谢谢。
出去，就是 physical 类见面。
好的。
好的。另外多保重啊，在美国。
对，你也
保重，谢谢王老师、张老师。新年快乐。谢谢。好，拜拜。
我的疫情尽快结束，对。
好的，拜拜。
拜，多谢。
谢谢，拜拜。
好，拜。